Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending August 23rd, 2024. I'm Preston Brennan. Thanks for tuning in. Well, the theme this week is Boom Boom Powell. That would be the Fed chair. Boom Boom Powell. He steps in finally, helps support the markets with an almost assured rate cut coming up at the September meeting. So we've got a solid week of gains in the market. Very solid. Let's just take a look at how this week fared, how everything moved through. And as you can see on the screen, everybody was in the green, both weekly and year to date. You can see the best sector was real estate. Obviously, with rates coming down, that's going to help any interest rate sensitive sector. The worst was energy. Communication services leading the pack just barely. 21.07%. Utilities is real close behind. Discretionary is bringing up the rear at 5.52%. So getting back to what I said earlier, the markets are celebrating Fed Chair Boom Boom Powell when he announced that rate cuts would be coming soon, essentially. The gains in the market, as you can see, are pretty much broad-based. We've seen small caps outperforming large caps because small cap tends to be more sensitive to interest rate cuts or hikes than large cap does. And the equal weighted S&P made new highs for the year. And Boom Boom Powell, he said basically the time has come for policy to adjust, meaning time to switch the interest rate possibilities going higher to let's start bringing them down now. So the only question now is how many cuts will they do before the end of the year and how many is going to come in September? I still believe it's going to be 25 bips versus 50 basis point rate cut. We have seen unemployment move up, which is scaring Boom Boom Powell a little bit. It was at 3.4% in April of 23. Now it's at 4.3% this past July. So, we've got that to contend with. The other thing, historically, coming up the month of September is usually, or statistically, not a good month for the U.S. markets. If we just look at the past 4 years, we've seen the markets down 3.9% 4 years ago in September, then 4.8%, 9.3%, and then the most recent year, 4.9%. So the markets have been coming down over 4.5%, 5% on average for the past 4 years every September. Maybe this one will be different. You can see the PE ratio, the forward PE ratio is about 5.54% lower than the trailing, but they're still very high, the forward, 23.15. Earnings yield for the S&P right now is 4.34%. You can see the 10-year Treasury closed down at 3.79%. Now, this past week, the economic calendar was relatively light, but came in at expectation. We did see existing home sales rise just a little bit. It broke a stretch of 4 months of declines. But the big surprise for the week from an economic perspective was the Labor Department's annual revision of its non-farm payroll count through March of 24. So they measure from March 23 to March 24, and it showed 818,000 fewer jobs were added over the previous 12 months than originally reported. Now, Treasuries rallied on that, which meant interest rates moved a little bit lower, primarily because that just means the market's underlying job growth is not as strong as people think. So that just puts more pressure on Boom Boom Powell to cut the rates at a faster clip. Okay. So you can see where we're sitting right now. Now, if we come over and look across the pond, and we'll take a look at Europe first, everybody was in the green from the Euro stocks, FTSE, CAC 40, DAX, all in the green for the week, all in the green year to date. CAC 40 finally moved back into the green this past week, coming in at 45 basis points above zero. Of course, the French markets were really devastated when Macron called that snap election in the middle of the summer. We also saw a business zone activity across the Eurozone pick up in August. It stalled a little bit in July, but it came in a little bit stronger in August. The PMI data came in at 51.2 versus 50.2. And France got a big boost with the Summer Olympic Games there as well on the services side. And the ECB, the European Central Bank, said growth in wages in the Eurozone, which is a key point for policymakers there and here in the US, slowed to 3.55% in Q2. And that was a slowdown from the prior slowdown of 4.74%. Okay. And we got minutes from the ECB's July meeting. They left their monetary policy unchanged in July, but the minutes basically expressed concerns about restricting economic growth too much. All right, so the markets there are predicting 2 more rate cuts before the end of the year. That's kind of what I'm seeing here. And then, of course, if we look over the Asian market, you see the Nikkei is up 94 basis points, 14.81% for the year. Following the Bank of Japan's second interest rate hike this year in late July. As all you guys know, I've been telling you guys in our free update on the weekends, one freebie I'll give you is be long the yen. And I've been talking about that since the beginning of this year. And those of you, especially our members that jumped in on it, was very well rewarded. But anyway, they hiked the rates. The Bank of Japan Governor Ueda, he basically reaffirmed there's no change in their policy stance. And they're going to adjust monetary policy pretty much if economic and price development stay in line with their forecast. And what they're saying, inflation data is still supportive of the Bank of Japan's hawkish shift this year. So inflation's coming in a little bit stronger, so that can afford the Bank of Japan to be a little bit more hawkish in their interest rate hikes, not cuts, which again is going to be conducive for being bullish the Japanese yen. So in July, inflation over there, CPI accelerated 3 months in a row through July to 2.7% year over year. Right, so it's matching expectations, but that's a good number for Japan because if you guys remember me saying for the past year, Japan is really putting a lot of stimulus into their economy because they really want to bring inflation back into their markets. They've been devoid of it for about 2 decades now, so that's a good thing for Japan. Meanwhile, over in China, the PBOC, they kept their benchmark lending rates unchanged, but they still have a lot of overhead drag from their real estate markets. They're hurting really big time. And the PBOC, they did keep their 1-year prime loan at 3.35%. But a lot of economists think they're going to continue to keep stimulus into that economy to help them survive this rapid slowdown that they've had all year long. They're the only major country right now. In fact, it's the second largest economy on the planet. It's in the red year to date, 4.05%. What I'm going to do is shift the screen over real quick, just walk through a couple of key indexes here. If we'll take a look at the S&P E-mini S&P 500 E-mini futures, it'll be coming on the screen in a couple of seconds. You can see here where we've been running flat almost all week. You can see here these candles, red, green, but the high point where we end up closing hadn't really varied that much. It cannot get up above that level. And that level right up there is a key fib node. It's 0.618 from prior pivot highs and lows. It's a key node before we have the possibility of taking out the all-time highs, which were made on July the 12th, right? You can see that the S&P at one point intraday was down 10.51%, the futures contract S&P. And then we've just moved like a rocket ship up. But I think it's going to take a little bit of time to digest these rapid moves. In fact, I'm looking for the markets to settle in just a little bit. We've got this week, we got a couple of big events happening. On the 28th, after markets close, we get NVIDIA earnings. All AI companies will follow that. And then on Friday, we get the PCE, purchasers or consumer price. And that is basically gonna really give the Feds more input. I do believe right now the Feds are more worried about employment than they are about inflation. I mean, Boom Boom Powell essentially came out and said inflation should be in the rearview mirror now. We're not concerned about rising inflation. We're more closely aligned with watching the labor market. So that's the data that we need to focus on. And the first big labor report we get is going to be the first Friday in September. That'll be after the Labor Day holiday weekends here in the U.S. Okay, so this is what I'm looking at here. Of course, if we look at the, let me just take it over here and we'll take a look at, where are we going right here? Let's take a look at the Russell. You can see on the Russell here, not as close to their highs for the year. The Russell was down 14.12% intraday for that low that we hit way back over here on August the 5th, that really ugly day. And it's bounced up. We're back solid in the green. We're above the 50 and the 200 EMA, and the 50s over the 200 EMA. So that is more of a bullish looking chart. I do believe we're going to get some softening in price, but you could see that big candle on Friday. That was interest rates, and Boom Boom Powell at Jackson Hole, Wyoming, in his speech at 10 a.m. Eastern Standard Time. He basically said that interest rates are behind us. I'm sorry, inflation is behind us, so it's now time to change our policy stance towards rate cuts. So that's going to really help small cap stocks. Okay. And then, of course, if we come down here and look at the Dow also had a good Friday. It was up for over 440 points. You can see the big candle here. Intraday, at the lows here on August the 5th, the Dow was down only 7.616%, but we're well north of the 50 and the 200. The 50's over the 200, so it's a bullish chart. So at least for the time being, I do believe we're going to remain bullish. I would expect some dip in the markets in September, but I think you're going to see buyers step in and we'll make new highs until we get into the October time frame. And we're going to get a lot of information on the labor data coming out the first week in September, and then the Fed's meeting the third week in September. That'll give us really good clues as to what they're thinking for future rate cuts. Okay. Now, one other key thing that I wanted to show you, let's look at NASDAQ. NASDAQ's not as strong as some of the others. Look at NASDAQ. This is NASDAQ 100. Intraday, they were down over 17.31%. Now, this is NASDAQ 100, so 100 of the largest companies, of which the Magnificent Seven make up about 45, 48% of the entire index. So obviously, they suffered during that pullback. We've moved up, but we're not up anywhere near the highs like we are in the others. But I'm going to show you who made a new high on Friday. Look at the equal weight SPX. Okay. Equal weight SPX made new highs for 2024, up 10.31%. That means that over the past week, we did have participation in other companies, the other 493 companies, while we're seeing some weakness in some of the tech companies, mega cap tech, and growth. You're seeing some money spread out a little bit, which is a good sign, guys. And now, if we look at the equal weight over the SPX, you can see here that over the past, it's been kind of steady to rising slightly higher. In fact, Wednesday, Thursday, Friday, the equal weight outperformed the SPX, right? We got a MACD crossing up. So that could mean we're starting to see a shift in the markets as well, away from some of the mega cap tech and into some of these other value-oriented stocks, more as a risk-off kind of thing, like utilities and others. So my recommendation, what I've been telling a lot of our members, is that you may want to start cutting back, paring back some of your Mag 7 stocks and some of your other tech growth, and then just are hedging a little bit more and just allocate a little bit more to value and some of these other sectors here, like healthcare and even the utilities. Okay. If we come down here and we look at volatility, you can see the VIX had a nice down day. We're still elevated. I mean, let's just blow it up a little bit. You can see that in this daily chart. We're still elevated in the yellow. We haven't been outside of the yellow and the green going all the way back to July, middle of July. And that's when the markets really took off. And then we had that ugly event happen to us on August the 5th. But then we've been giving it all back up, and you can see a little bit of a round here. I do believe we're going to see the VIX start to settle back down a little bit as we move through the end of this month. Now, I think we may get another spike or two in September, because September, as I said, past 4 years, we've seen monthly drops of 3.9, 4.8, 9.3, and 4.9%. So that's a lot of drops in the month of September for the past 4 years. I do see an opportunity of a little bit of a dip here, but I think buyers are going to step in this September dip that I see coming. If we look at the front month vol skew, you can see here this compares the VIX and the September volatility futures contract. We're literally right at the zero line. I'd like to see it more in the green. So we've still got a skew out there that is favoring a little bit of a near-term pop. If we look at the back month skew that would compare September and October volatility futures, we're solid in the green. So really, most of the fear is starting to dissipate, but there is still some fear going out into September. Right now, understand we got a big election here in the U.S. coming up in November, so we will see vol and the VIX start to get a little bit more choppy as we move through October into early November, into election day. If we come over here and look at Treasuries, you can see the bond market was up in the green on Friday. In fact, we're just kind of barely in the green year to date, which means interest rates are in the 30-year lower than normal for the entire year. And we haven't been really in the green all year in the bond market. We first went into the green on August the 2nd, right? And then we're back in the green again, but we don't seem to hold it. So let's see what happens here. That keeps the 30-year interest rates lower. It'd be interesting to see where that plays out. And then, of course, if we look at currencies, we're real big, and I'm all over these currencies. If you look at the dollar, it's doing exactly what I said it would do. It's giving it up. We're now into the red year to date for the dollar. I mean, just look at this. This is low-hanging fruit trade right here. You get this thing making lower lows. The 50 crosses the 200. Any rally here, I said, is probably going to be sold off, and then here we go. Now, naturally, guess what's the direct opposite of the US dollar? That would be the euro. And the euro is doing exactly what I said it would probably do, which is move higher. In fact, you can see the euro is now in the green for the year, and it made new highs for the year on Friday, up 1.28%. Okay. I do believe the euro is going to move up to the 114, 115 to the dollar area. We're going to get a little bit of a dip, and then there are going to be buyers stepping in on the dip, and then I think it's going to go higher. And now let's look at the yen. The yen is the same way. The yen, I was saying back over here, you want to be long the yen. It took a little bit of delay from the Bank of Japan, but away it went. That dip, buyers are stepping in. And I think it's going to move higher, right? I think right up in this shaded zone is where it's going to be as we round out this year for the Japanese yen. Okay. If we come down here and look at gold, well, guess what? Gold is just soaring. You can see gold had a 2024 high price on the 20th of August, up over 24%. My original target was right here at 25, and it hit 2570. And you'll notice that when it pulls back, it'll pull right back to that 2500 area. It's a natural support area. But look at the upward vector on the 50 and the 200 EMA, straight up. MACD, there's no divergence there, so that does say volume is coming in. And you could see the volume. Let's just zoom in a little bit more. Volume is going to start to dissipate. It started to dissipate on this run here, right? You could see the purple line, which is a 5 EMA of volume, and the blue line, which is a 20 EMA of volume. So you can see the volume on this entire move higher, and the purple line has moved lower. So that tells me that we should expect a pullback possibly to the 50 EMA, which would put us around 2440 roughly. And we closed out the day at 2548. So another 110 points lower over the next week or so. Couple of weeks, 2 or 3 weeks, I think, into September. Now, look at silver, though. So just fix in your mind where gold is. Near highs for the year, well north of the 50 and the 200. If we look at silver futures, it's a completely different chart. I mean, it's barely holding on to the 50 EMA, and it just moved up above the 50 EMA back on the 16th of August. So silver and gold traditionally go together. Usually gold will lead the way higher or lower. And right now this suggests silver should go up, but the Elliott wave count is suggesting silver is going to pull back, possibly to the 200 EMA around 27, which kind of goes in line with what I'm saying about gold pulling back as well. So we should see that over the next couple of weeks. If we look at oil, had a good strong day on Friday. But look at it. We had this double test down here, and then we made a triple, actually a little bit lower, almost went into the red for the year. You could see right there on August 21st, and now we're getting a little bit of a run higher. But any run higher is going to be like this run higher. It's going to be sold off. The 50 just crossed below the 200, so it does suggest that generally you want to be a sell a rally kind of trader if you're trading oil. Okay. And then, of course, if we go to nat gas, I want nat gas to keep going lower and lower. There's an abundance of supply out there. My target for nat gas is down around 1.78 down in this area here. If we get down here, we're going to switch over and start to become bullish again, right? The last time we were bullish nat gas was over here. We had a triple bottom, and over here we were getting MACD bullish divergence, and I said, you got to go long here, and it turned out to be a great trade. Well, I think we're going to get something similar. Not sure if we're going to go down and take out these lows here because they're awfully low, but I think my target right there makes sense. All right, everybody, that's kind of where we're sitting on this weekend. On the weekend of August 24th is the date today. So I will see you guys later. Next weekend is Labor Day weekend here in the U.S., so we will not have a weekly roundup. Members, I'll see you tomorrow evening for our weekly market watch. Take care, everybody. Ciao now.